Hey everyone, Couch Investor back to another video for today. So let's have a look at what Cathie Wood and ARK Invest have been buying lately. More specifically, three companies. Some of them have been talked about on this channel. Now, of course, all three of them, ARK Invest, are down heavily, and just because they bought these shares does not mean that you should buy these shares. But I would like to make a point here throughout the video as to why ARK Invest keeps buying those smaller types of companies while also selling the likes of Tesla, for example. Now, throughout the video, I'll give you a little introduction of the company, their latest earnings report, look at the graph, and then at the end, we'll conclude it and you can make up your mind, share your thoughts down in the comments below. So let's have a first look at the Friday activity. So this was the ARK-K ETF. You can see they bought PagerDuty, Twilio, Zoom, Teladoc, Invite, and sold Exact Sciences, Shopify, and Tesla. As for the ARK-W, they bought Pure Storage, PagerDuty, Twilio, Zoom, Teladoc, sold Shopify, and Tesla. ARK Genomics bought Teladoc and Invite, sold Exact Sciences, and then ARK-F, they bought Twilio and Teledoc and sold Shopify. So I hope that by now you already know probably which three companies we're going to cover in this video. So first one is Teladoc. Now Teladoc used to be a high flyer in ARK's ETFs. We're going to have a look at their position in their ETF in just a bit. But right now, it has been coming down. Not because they believe less in the company, but just because the stock price hasn't really moved much compared to the other companies in their portfolio. But this is currently the state of Teladoc. As you can see, year to date hasn't really done much. It's up 5.29%. In the last 12 months, it's down 14.4%, has a market cap of just over $4 billion. Now, when you look at revenue, yes, throughout the years, it has been increasing. Yes, of course, in the last couple of quarters, it has been plateauing. Now, when you look at free cash flow, it is free cash flow positive. You will see operating activities, operating cash flow is positive as well. So things are becoming a bit better there. But of course, return on equity still very, very negative. Gross profit margin has been improving, and this is a crucial point. This is something that management has told investors for a while that should become much better. Of course, at first, didn't really happen. Then we had a couple of quarters where it was okay. Let's see if they can continue to perform. Now, for those that needed a little reminder here, so this is basically what happened since Q1 2022 until Q1 2023. So yes, revenue has increased year over year, but growth rates have been slowing down. If you look at gross profit, yes, that has also increased year over year, but from Q4 to Q1, it is down. Adjusted gross profit, same story there. Gross margin, as I've just said. Then adjusted gross margin, the same thing. You can see a little bit of an improvement, but it's still not as stable as we'd like it to be. Then when we look at the graph, to be honest, still far, far away from the 200-day moving average. Currently, as you can see, we're between the 20 and the 50-day moving average. We didn't really have that much strength to go over that. RSI, still pretty neutral. MACD, bullish, but still under the zero. Right now, basically, this is a type of stock where Wall Street is, well, let's wait and see what the next quarterly earnings will be, and then we'll make up our mind. In the meantime, ARK Invest are nibbling here and there. And so, if we look at the combined ARK Invest ETF holdings and we scroll down, we can see that Teledoc is now the 9th position across all ETFs. And yes, they are in red in that position pretty heavily. Up next, company number 2, and this is a company we've covered a couple of times on this channel as well, especially the earnings report. So if you missed that, it's going to be in the top right corner, and that's Twilio. Now, Twilio, the same thing here over the last couple of years. The stock has been, the revenue has been going up quite nicely. The stock had its period, but then, of course, post-pandemic reaction didn't really perform that well. So revenue in the last 12 months have been growing, okay, pretty steadily, but growth rates have come down as with every other company out there. Now, if we look at free cash flow, not the direction you want it to see going. And then the same thing here for return on equity, still negative. Gross profit margin has been coming down as well. Shares outstanding have increased in the last couple of years, but with share buyback programs, they have reduced it a tiny bit. Now, currently year to date, it's up 38%. Return the last 3 months up 5%. Since last year, it's also down 14%. It has a market cap of $12.44 billion. Now, as for the highlights from last quarter. So revenue grew only 15% year over year, organic revenue also 15%. And if you look at data and application revenue, 19% growth there, which is less, and this is with Engage, and which is less than the 25% we've seen before. Communications revenue only 14%, then other revenue insignificant here, but that grew 26%. Other metrics, operating margin, non-GAAP 10%, dollar-based net expansion rate 106% has been coming down each and every quarter. Now, of course, with Twilio, I already explained why this is happening, because their clients, specifically for their clients right now in the macroeconomic environment, these are the types of clients that, yes, are cutting back on spending, and so this hurts Twilio directly. Now, of course, when the market will turn, it is possible that spending will reaccelerate with Twilio, but it's also possible that these clients are out of business or suddenly have chosen another option, because guidance here wasn't great as well. And so the stock reacted accordingly after the earnings report. But since then, the stock has actually gone up close to 50%. So yes, you might say that $45, as you can see here, might be a good support line. I don't know if we're going to ever revisit that point, but just for future reference, yes, $45 was a pretty good support line. Now, currently, we're still not close-ish to the 200-day moving average. We're well above the 20 and the 50-day. RSI is still pretty neutral. MACD bullish as well and still under the zero. So yes, maybe with a good earnings report, this stock might continue to go up. Now, as for ARK's position with Twilio, it sits at the number 12 position across all ETFs combined. So Teledoc was number 9, Twilio is number 12. And yes, again, both of them were much higher before. And if you're interested to know who dominates the top 5, well, it's Tesla, UiPath, yes, I know, pretty surprising, Roku, Zoom, and Square. Now, if you're enjoying this video so far, leave it a thumbs up, subscribe if you have not, I would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, let's have a look at company number 3, which is PagerDuty, which I think I only talked about once on this channel, which was a long time ago, maybe even 2 years ago. So PagerDuty, this is the current state of the company. Again, same story here. Revenue the last 12 months throughout the last couple of years have increased quite nicely. And right now we can see here in the last 12 months, free cash flow has become a bit more positive, which is always a positive sign. Return on equity in this case also still negative close to 43%. As for gross profit margins, it was at its peak at 86%. We're now bottoming out at around 81-82%. Now, currently, year to date, the stock is down 15.66%, so the worst performing of the 3. In the last 3 months, it's down close to 30%, and since last year, it's basically flat. It's down 1% there. Market cap of just $2 billion. So if you're looking at those low market caps for potential huge returns in the future, if this company continues to execute correctly and succeeds, then yes, $2 billion, you could see maybe a potential multi-bagger here. Now, when you look at the stock, it doesn't paint a pretty picture. Basically, we've hit a resistance points back in April here at around $35, which we also hit back in 2022. And since then, we've gone all the way back down. Of course, they reported earnings on June 1st, which made these red candles even bigger. And right now we're closing in what was previously a support line back in November at around $20 or so, but still RSI not oversold. And yes, MACD right now is pretty bearish. So what exactly has happened? So revenue increased 21% year over year, dollar-based net retention of 116%, operating cash flow margin of 21%, customers that spent over $100,000 is up 17%, paid customers at 15,000, and then free and paid customers grew 19% year over year. But we also have a comment from ARK Invest. So when they reported earnings, the shares traded down around 17%. And this is despite revenue surpassing expectations, but guidance was the issue here. Management cut full year revenue guidance based on the persistent macro headwinds that are extending sales cycles and limiting seat expansion. In our view, as artificial intelligence increases the efficiency and productivity of software developers, demand for automated incident support software will increase. Thanks to its proprietary data and early adoption of AI, we believe PagerDuty is positioned to be a prime beneficiary of this trend. PagerDuty is a California-based software-as-a-service company that hosts an IT incident management and reporting platform and other process automation. And where do they stand in ARC's combined holdings? Well, we have to scroll down a little bit more here because they are at the 20th position there between Beam Therapeutics and Verisight. And here actually they are pretty close to being break even, with two positions between around $25 to $29. So to conclude, as always, ARC is the type of active ETF where if one company is doing pretty well for a while, they're taking profits and then investing those profits probably in some of these positions that have not performed quite well for them. As we've seen, Twilio, PagerDuty, and Teladoc, the stock hasn't really moved that much compared to the other holdings that they sold. Now, does that mean that they don't believe in the other holdings that they sold? No, just them being active and trying to reduce the cost basis of those poor performing companies. Now, I don't hold any of these three companies. I did hold Teladoc before, but it was just a tiny position, didn't make any sense for me to have it anymore. But do you hold one of these three positions? Do you agree with ARC that right now is a right buying time, or is it just sell, go away, and try something new? Leave your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.